to the Retail Tech Podcast, where we dig in deeper into the technologies that run retail, online, in the store, and everywhere in between. Today I'm speaking with Len Eschweiler, the SVP of Retail at the company called Affirm. How are you today, Len?
Doing great, Darius.
Thank you so much for taking the time to talk to me. What is Affirm?
Yeah, and Darius, thanks for making time and having me this morning. So Affirm, what we drive is something called honest finance. And honest finance is a different approach to credit that's based on some simple principles around trust and transparency. And it really changes the way that both consumers and retailers think and use credit. At a high level, it manifests in driving material incremental sales and growth for retailers, but is equally important, it does so at promoting high levels of customer engagement and high levels of customer satisfaction. And I'll share with you, customer satisfaction, high levels of customer satisfaction is not generally something that is associated with credit. And it's been really exciting to see how both consumers and retailers have rallied and supported this mission and the solution that we're bringing to market, encapsulated in honest finance. And I look back over 2015 to 2016, year over year, and we grew from just around 100 retail partners that we worked with to 900, and now in 2017 that's growing. And the value that we're creating for retailers went from over triple growth into hundreds of millions of dollars of sales volume that we're driving for our retail partners. But I think the other important piece of that is doing that at an NPS score of close to 80. And to my point around associating high levels of customer satisfaction with credit, most of your credit type solutions can be in the negative area of NPS. And so we take a lot of pride and focus, and I think it's a manifestation of how we're approaching our solution. I'll get into some of the details of how you offer credit, but how do you do it in a way that really supports the customer, and the customer in turn is rewarding those retailers through not only spend, but a high connection to, again, satisfaction and brand engagement.
Okay, and so as far as the history, I think the founders go back to the PayPal pedigree, I think, right?
Yeah, so our one of our co-founders and CEO is Max Levchin, and Max is known for doing a lot of really cool things. One of those is being the original founder of PayPal. He was the founding CTO, and since PayPal, Max has done a lot of really exciting things. He is drawn to some of the harder problems, I think, and sort of reinventing credit and reestablishing credit and the relationship of how businesses use credit, and importantly, how consumers think about the relationship with a company that's providing them credit is very different, and of how we've approached this. And so the company has been in business for about 5 years, and we really started to scale as we looked at last year into this year out into the retail community. And we're a mixture of, when we look at the DNA of the company, we've got some really exciting experience, not only from the financial services, but from e-commerce and technology, and have been seeing some significant growth as we've been executing against our mission.
Yeah, I mean that level of experience in finance, and actually, the financial aspect of online commerce, you probably can't get better than PayPal, because that's like really they created a brand new category. Affirm, from what I know, is pretty tech savvy, so that you use technology really heavily to help make the decisions for the financing, correct?
That's correct. I would say one other piece, Darius, to build on the experience is that you're right. A lot of the things that Max created with the team at PayPal, those became underpinnings for really transactions of the future, of how people are conducting transactions today. the other piece of a business like this where you also see a lot of, I think, importance when you think about scaling a business and redefining a category is having a lot of experience also on the consumer side, the regulatory side, the governmental side. And so we also spend a lot of effort. Max is an advisor on the Consumer Financial Protection Bureau, and we have experience also working on how do we champion the cause of the consumer to do what's in the best interest of the consumer while driving value to retail. So you've got this interesting mixture of, to your point, technology, a lot of depth of experience in technology, financial services, e-commerce and retail, but also from a regulatory and consumer advocacy standpoint as well.
Right. So as far as the technology itself, what are some unique things that Affirm is doing on the back end to help, for example, make decisions on credit?
Yeah. Well, let me frame it in frame that in some of the problems that we hear out there, or some of the issues that are confronting retailers, and then I'll align the way that we approach some of our technical solution and just the way that we manifest our solution to address some of those issues. And these are higher level thematic things that we hear. But one of the things that we hear really across the board are retailers have concerns around increasing cost per acquisition. Their customer acquisition costs are going up. And there's also concerns about connecting in a relevant and authentic way with customers, and that when we think about credit, you have a big number of customers out there spanning a wide variety of economic and social demographics that just don't want traditional credit products. And there's some reasons for that I'll explain. But when you think about that promise, how do a fear of sort of missing out on connecting with these changes of what customers are expecting in how they actually transact business? That's one of the things that we hear, and that can manifest itself in increased customer acquisition costs. The other thing that we hear out there in the market and from our customers are, I don't want to discount, or at least I don't want to discount as much. And I think that a lot of the big players, and Amazon being one of them, that has done a great job of raising the bar for customer experience, but they have leverage that most retailers don't have as it relates to price. And so you have a lot of retailers that are trying to maintain price integrity, and discounting is probably not the battleground that they want to fight. And so we hear that as well. The third thing is focus on making sure to capture as much mobile sales as possible. And I think that many retailers are feeling like there's unrealized potential as more and more consumers are moving to mobile, and we see these dramatic growth curves that have been happening for years in mobile traffic. But what's been happening is that the sales growth has not been tracking proportionately with that mobile growth from a traffic perspective. And so there's real concerns about how do we bridge that gap. And then the fourth thing that we see that's been really encouraging over the last few years, it's picked up a lot of steam, but there's been several companies that have been championing this cause for a while, is differentiating on having a strong set of values and a strong North Star about the experience customer satisfaction. And what many retailers are thinking today when they look at their values and their customer experience, traditionally things like credit and payments sometimes haven't been part of that conversation, because once the transactions happens, it sort of happens outside of the retailer's environment. Well, we're finding that businesses of today that differentiate on a strong experience, strong customer satisfaction, they view all the touch points of their customer as being integral to supporting their value proposition in their brand experience. And so we think about how that's evolving, and the net is widening of what customer experience means to retailers and how we help them support that. So when we think about, just to summarize though, increasing customer acquisition costs, the potential of missing out on connecting with wide swaths of the population, millennials are a big group there, staving off discounting, capturing and optimizing for mobile, and then really looking at ways to differentiate on values. Those are some of the big problem questions that we hear out there. And I think to your question, how do we then organize our solution to help retailers not only address these, but be rewarded by customers for a different approach of going back to the introduction on honest finance and what Affirm is offering.
Right. Those are pretty existential challenges for retailers, especially in today's world. The last one, customer satisfaction, and you mentioned, that Net Promoter Score, focusing on that is really interesting. I think it's really important, especially for retailers, because retail, especially, it probably doesn't have a very high degree of satisfaction. People complain a lot about going to the store and not being treated well. So some of the best companies, more successful companies we can think of are, for example, Zappos made its business by taking care of the customers in a way that they were not, used to. Company that just got acquired by PetSmart, Chewy, also very highly focused on customer service. So I think this is, we're all, technology companies. This is the human side of the technology that it really actually pays off to focus on.
Yeah, I agree. Those are great examples. Those are great examples as we think about the customer. And you've got a whole new batch of, businesses that are, driving that experience on really embracing that business can be a force for good. And that has some different implications. And I think a lot of customers are looking for those types of businesses and respond well to those types of businesses. And, to maybe dig into a deeper level, because I agree, I think these are existential type of threats or opportunities to the retailers of the future. And when we think about it in the context of finance and credit, the reality is that whether we're talking about, I mentioned where customers, you have wide swaths of customers that either don't want traditional credit products. And when I say traditional credit, I don't just mean the long-standing private label credit card businesses. I also include a lot of the new generation of alternative lenders in the mix of traditional credit. And why I frame it that way is most of these organizations, whether they've been around for a long time or they're new to the scene, they leverage the same sort of tricks and tactics and sometimes unsavory programs that can really take advantage of customers. So most of these types of credit products that are offering 0% programs or no payments for a period of time or coming in with really low pricing, how they pay for all of that is through some penalty interest and penalties and deferred interest. And these are things that end up becoming fairly significant revenue lines for a lot of different credit providers. And the reality is they're not aligned with the customer's incentives when you think about how some of these deferred penalty interest programs work. And they're rampant. They're rampant in both traditional credit as well as some of these new alternative lenders. And what can happen, to the point of the customer experience, is that we're finding that more and more customers aren't disassociating the experience they have with the credit provider versus the experience they have with the retailer. And if those experiences are incongruent with each other, the customer chooses to put their loyalty somewhere else. And so when we started the idea of our solution of lending and honest finance, we stepped back to say, where are there opportunities to really change how this business is done and how you connect with customers? So more specifically, I'll put this in a couple different tracks. But the first is when you think about underwriting. And most businesses that we're talking about that are in credit use a system for risk determination in FICO. And I think most people know their FICO score. You get your score, and you may use that if you're buying a house or a car or something like that. And the reality is FICO score has been around for a long time. And that's the decisioning model that many credit providers use in determining the creditworthiness of an individual consumer. The challenge is the FICO model can underrepresent a majority of customers. I'll give you an example. Millennials and this is one example, millennials who are the largest portion of our population now and will own the dominant portion of spend in the next 5, 10, 15 years. When you overlay their general FICO score across the different bands of FICO, their average FICO score is around 620, 625, which puts them squarely in a subprime bucket. And so if you're doing credit decisioning on FICO, subprime might be a place where, quite frankly, many of those customers won't be approved. And if they are approved, they're not given very great rates. You combine that with some of the survey data that we've taken. In our latest survey from just a month or so ago, we talked to over 1,000 respondents. Over 60% of those respondents said that they were worried or very worried about using their credit card. And 3/4 of those that expressed that concern were worried about not knowing exactly what they'd pay or potentially getting in over their head, because the reality is that credit can be very confusing if you carry a balance when you talk about compounding daily APR type of calculations. It can be very hard to budget for that and think about what you're spending. So the second piece from your question about what we're doing from a technology and solution standpoint, the first is, let's just look at completely changing the way that we think about underwriting. And that's a very different approach of how Affirm has approached credit, where the majority, whether it's a traditional provider or this batch of new alternative lenders that are either just getting started or trying to get into the U.S., are basing their decisions on FICO. The second piece, and I mentioned some of these programs around deferred penalty interest. The second piece that we said was, let's determine a model that is not based on viability for penalizing customers. And so we got rid of, in our world, the concept of deferred and penalty interest. So when a customer is approved for a loan with Affirm, they know exactly what they're going to pay. We show them exactly what the amount is. They're not going to pay any more. And when we do 0% type programs, which can be a very powerful promotional tool for a retailer to drive incremental sales, it's true 0%. It's not deferred interest that has these mechanisms lurking in the background to accelerate interest and do some really, again, kind of unsavory and unfriendly type of behavior to the customer. So those are some big things that we set out to change. We're increasing access by changing underwriting, just fundamentally changing the underlying model of how you create a viable credit business and make sure that it's aligned with the best interest of the consumer. And then we, from a technology perspective on the application process, the flow, we retooled that so we made it really simple. So when you go through, if you're applying for credit with Affirm, we ask for 5 pieces of data: your name, your email address, your birth date, your phone number, the last 4 of your social. We give a real-time decision. And if you're an existing Affirm customer, it's really just you hit a tap. We give you an activation code, and it's a couple taps, and you're done. And when you think about that problem set, that existential threat of mobile, just using a credit card, let alone a credit application on mobile, is really burdensome. And so we're finding that our process is just much more refined from an experience perspective, not only desktop but in mobile. And in fact, we have some customers tell us that our conversion rates and AOV conversion rates are on point with their desktop, but AOV is dramatically higher from mobile to desktop. And I think so that's bridging a really important gap as consumer expectations, consumer shopping behavior are changing. So there's a lot there, Darius, but I think that when you think about these existential threats and opportunities facing retail, and then you overlay that against how a credit business works and the role that credit can play in helping address these issues, it becomes really exciting. But the difference is, and this is hard to, as you look at the landscape of credit, it can be hard to really tease apart what is just old type of rules being wrapped in new clothing versus what is truly innovative and is truly changing the way that credit can be used as a marketing and merchandising component, as well as heightening a different type of relationship with the customer. And ultimately, that culminates in how I mentioned these high levels of NPS or customer satisfaction, because we're really doing right by the customer, and they in turn are rewarding retailers for treating them right.
Right. So I think really just the term honest finance is something that we all need to think about actually a little bit deeper. It's easy to say it, doing it is completely different, and so that's something that I need to let sink in with what I'm learning today about what a firm is doing, and then going back to how you actually got rid of some of the fees and the I guess penalizing people for being late or whatever. So knowing that that is a major piece of the revenue model for traditional finance, how does a firm make money then? How does that impact your ability to generate income if you don't have those fees?
Yeah, what it does is it really puts the responsibility on our underwriting to make sure that we're underwriting customers that we feel, one, are in a place that can afford and pay us back, and two, they're customers that we should be extending credit to. And what we've found is that through our underwriting, in our smarter underwriting of doing that across the industry, we actually approve much deeper across what we'll call full spectrum lending, from super prime down to thin file. Across the board, we approve better, and our default rates are lower than industry average. So it really, how it works is that it puts a lot of responsibility on our ability to underwrite effectively. The other thing I would add, Darius, that sometimes isn't thought of when we look at credit, and when someone is thinking about credit or credit cards or even some of these different lending solutions that are out there. At Affirm, the other thing that we do for the merchant is that we take full risk and fraud. And so there isn't this concept of for us, there isn't this sort of chargeback or or from a return perspective, we return all fees. And so we're very friendly, not only customer to the merchant, but this all centers on, can we underwrite in a way that allows us to extend credit to people that will pay us back? If you're focused differently, and you know that 20 to 25+% of your customers, and you expect that in your models, that will fail, and that's how you're going to pay for your programs and sustain your business, that construct, by definition, will always be wired to have a portion of the business driven on customers screwing up and failing. The other piece to this, that particularly if you're a CMO or a chief digital officer, you've got a lot on your plate. And the thing that you may not be engaging with on a regular basis is the idea of capital markets, which essentially for a credit business is where you fund, and how you actually provide the funding mechanisms to provide loans to consumers. And to do a business like this at scale, you have to have a very comprehensive and well thought out capital market strategy. So you can not only do this at scale, but you can do it in a way that actually provides economic viability while you're growing. And that's a thing behind the covers that you don't necessarily see, particularly with not a lot of new entrants to the space. And I think from a retail perspective, it can be hard to discern what's sort of marketing and then what is sort of sustained, scalable structures and business processes to deliver on this consumer value, this consumer and retail value promise.
Okay, yeah, that makes a lot of sense. I think an important point you mentioned is really setting your expectation and your goals. If you set your expectations that 75% or 25% of your customers are going to not basically abide by the initial expectations of paying on time, that becomes a part of your solution. And then you sort of like, you get used to that and you actually become addicted to it. So I think,
right.
that's the truth. That's a fine. The banks are addicted to these fees. You you try to remove them and they have a withdrawal impact. So
Yeah, you're
so
absolutely right.
so this is really good that I see that you're actually setting your eyes on really the core of the issue is to help people and make the right decisions to improve that percentage for yourself, and then you actually generate even more money, more income revenue down the line because you have better decisions. So that's very interesting. Now let me ask you, so how would a retailer start using Affirm?
One of the things that we hear, and well put, Darius, very well put. And one of the things that we hear from an implementation over and over again is that we are one of the most buttoned up and easiest implementations that our retailers see. And part of that is we have components, connectors, and cartridges for the leading e-commerce platforms. The other is that our documentation and our API calls and our team to help with implementation is at a very high caliber. And so the integration to take advantage of the solution, there's two primary steps. From an integration perspective, we're talking days, not days and weeks, not months and years. And then from the other really important point to make sure that you get full advantage of the Affirm solution is how do you actually message to the consumer earlier in the buyer journey so you can have some influence on shopping mindset. And so we spend time with each customer looking at their overall user experience on the front end and how do we integrate messaging and opportunities to communicate Affirm earlier in the buyer journey. And what that does is that starts to change the shopping mindset before somebody adds something to cart. And that's where it gets really exciting. And I think we have some unique opportunities because of the flexibility of our solution of how you can start to think about communicating. I had mentioned credit as less about a payment or the utility of transaction, but really as a mechanism to drive shopping mindset and intent, because you start to plug credit as a component of a marketing message or a merchandising program. And more specifically, if you think about if someone earlier in the buyer journey is seeing that they can there's some as low as pricing, or there's a 0% opportunity, or they can pre-qualify for a spend limit before they start to shop, that really has an impact on the shopping mindset while they're in the discovery mode prior to adding to the cart. So when we look at implementation and working with retailers to get full value of the solution, one is making sure it's just super simple. These retailers have so much on their plate, and they need to implement things that are really fast, really easy, minimizes their actual technical burden, and can provide immediate impact to fund a bunch of the other things that they're working on. But the other thing that we take a lot of ownership with that's important is that we come with a series of best practice and ongoing support to make sure that we're helping on this customer engagement, customer experience standpoint, that a retailer gets full value of the things that we're learning on a daily basis to help them continue to iterate, test, and utilize the full value of engaging earlier in the buyer journey.
All right. So then I'm assuming basically you have, as you mentioned, you have APIs that the retailers can connect to, and does the system actually have to integrate with the retailer's commerce program, and then it runs the transactions through there, or how does the or is that something that we can maybe take up later at another time?
Yeah, we could get into details probably at a later time, but I would say just from a simplicity standpoint, when a retailer integrates, and if they're on an existing platform where we have a connector built to, whether that be anything from Salesforce Commerce Cloud, formerly Demandware, to Oracle, to Magento, to Shopify, and a whole myriad of other really nice platforms. Essentially, that integrates within that component or that cartridge, and then we flow our orders back through our integration, and we actually handle all the processing, which allows us to handle all kind of some of the cool things we've been talking about, take advantage, support all the risk, take all the fraud. and then we have some different connection points that give visibility into their transaction pipe, so they can see those orders, they can see those transactions, and we can also do, the other piece of the puzzle that we haven't touched on is really important to this is the downstream servicing component and what that looks like when you get into situations like refunds and returns and exchanges, and also just supporting the customer through the process of them making payments. So it's a really streamlined connection point to their e-commerce platform, and then depending on the retailer, there may be touch points with their OMS system, depending on how connected or disconnected those are from their e-commerce platform. And then there's some really exciting things that we're doing in store that I'd love to reconnect with you in sort of the short future about some of the cool things we're doing on the in-store experience.
Definitely, I would love to learn more about that. Just to wrap it up for today, I want to ask you a question. We hear these bad, negative news stories every day. Almost every day these days. That stores are closing, and physical retail is doomed. What is your view of the future of physical retail in the next, 10 years, 5, 10 years, looking beyond just, right this year and what's happening right now?
Yeah, it's a pretty challenging retail climate, to say the least right now, and particularly when we look at physical stores. I do think there's some recalibrating and correction. That there was some interesting article written. I am apologetically forgetting the journalist that wrote this, but I thought it was an interesting take on sort of the overcapacity of retail square footage in the country. And so there's probably some adjustments that are happening on just a recalibration to sort of right size some of that retail square footage. And it's interesting, as we look across retail, some of your tier one premium malls are doing pretty well, and the stores that are in those are doing pretty well. I do think that what you'll see as a trend that's following what we're seeing online is that for your commoditized products, and that goalpost is continuing moving, those types of products lend themselves to really be owned by some of the larger players, because there's a benefit for scale in there. And what we find is that the highly curated, special selection, customers that are really focused on their North Star from a values are changing the way that retail will look like going forward. So I think you have this recalibration of sizing for market, as well as a recalibration of what does that retail experience look like, because the reality is that people, they like the convenience, they like shopping online, they're comfortable with it. There are a lot of consumers that like actually the retail environment, the experiential nature of it, if it provides a true kind of value-add experience and differentiated environment for them. And I think a lot of retailers are going to be rethinking that strategy and are needing to rethink that strategy. And those that have a hard time with that will have a hard time going forward. And I think we're on the cusp of seeing a verge of a whole new set of retailers actually enter the market. And some of those are starting from the online standpoint, or starting from an online business first.
Right. Yeah, I think I definitely agree with the experience. You have to make it worthwhile for somebody to actually make the trip today, because they can probably find what they want online if they really wanted to do it. The other thing that I see is retailers really need to understand and use is technology. Technology is not just something on the business side anymore. The consumers are driving the technology. So no matter how good your experience is, if you're not connecting with consumers when they're not at your store, and even when they are at your store, with their own liked or preferred devices, then you're going to have a challenge of keeping that customer. So
yeah,
awesome. Well, thank you so much. This was great. I look forward to talking again and learning more about the in-store applications.
That sounds fantastic. Darius, thanks so much for the time and hosting me.
Thank you.